Hi, it's Lee, and welcome to the Tesla Economist. Tesla's lowered prices again, mainly in Europe, but also Singapore, New Zealand, and Australia, and some other markets too, which seems very relevant to most people's concerns and thoughts with the company as of current. Right now, there is overlooming concern from many investors that demand is down for Teslas. However, to the contrary, sales have never been higher. But truthfully, the economy is not in great shape, and interest rates are higher, which makes cars more expensive. Tesla's lowering of prices is somewhat an adjustment for the extra interest consumers have to pay when buying a new car. And in addition to that, Tesla are increasing production, which means they need to find more buyers every quarter for the additional supply. And there are two camps in the investor community here. One that thinks Tesla should be spending money on advertising to drive demand, and the other that almost encourages more price drops and actually think this is bullish. For one, the economy will never be consistent. There will always be times where cars are more expensive to buy and times where they cost less. There'll be times when people have more money and times when they have less. Hence why the auto industry is cyclical. Obviously, only a year ago, the auto industry was doing a lot better. However, Tesla are also producing about 50% more cars since then too. That's a lot more buyers to have to find every quarter. In fact, now there isn't really any backlog. Every quarter, more new customers need to be found from the previous. So it doesn't necessarily mean demand is down. It means that Tesla just need more demand to match the additional supply. And with everything else being equal, Tesla would have to lower prices every quarter to create sufficient demand for this additional supply. This is the law of supply and demand. We're only talking about additional sales here, quantity of sales. We're not talking about quality. As in, Tesla could in fact cut supply and keep prices higher and remain more profitable. In fact, Tesla may very well be more profitable with 350,000 vehicles produced a quarter rather than 450,000. Is that really Tesla's goal, to maximize profit for each quarter? Because that's about as far as the strategy looks the next quarter. Tesla have their targets set on next decade, or possibly decades, with their mission. Cutting back production by 30% or so just to reap higher profits does not at all sound like something Tesla would do. Tesla is aiming for growth. Tesla's main objective for growth is to get costs down. How can you get costs down if you start producing less of the product? Because Tesla very much believes in the advantage of economies of scale, Tesla continue to ramp up the Texas and Berlin factories, the ones with the latest in manufacturing knowledge, from the best engineers, implying that the economies of scale and evolution of building a third and fourth factory to build the same car that two other factories are already building has surely got to mean that there has been some serious evolution and learning curve from each factory. Think what Tesla learned from Fremont, all the knowledge that was used to build Shanghai. Then think of the manufacturing knowledge Tesla obtained from China, building those factories, and spending a lot more time and resources on more research and development into how to build the electric car for as low a cost as possible, and then build two massive factories with that new expertise and knowledge. I think that Berlin, Texas are still mainly cell constrained. They could likely ramp up them with LFP cells if they so chose. I would guess the factories possibly could be ramping faster if they did have more 2170 cells too. But either way, we're seeing them ramp, and more 4680 models from Texas too. So over time, I think the marginal cost per additional unit will possibly be at its lowest cost we've seen yet. What I mean is, in theory, the cost of a 4680 Model Y to produce one additional unit should be at an all-time low. I'm guessing possibly even as low as a Model Y rear-wheel drive from Shanghai, at least when the 4680s are at a more reasonable output. Of course, a 4680 Model Y is more valuable than a rear-wheel drive, implying this should be the highest margin Model Y that Tesla make. The remaining 500,000 or so Model Ys that are still to come out will be from these factories, and will be 4680s or possibly LFP, but they will have the highest margins. In addition to that, the ramping in Europe means they're not facing import tariffs compared to importing the rear-wheel drive from Shanghai, not to mention the additional shipping costs too. So Tesla can produce lower cost Model Ys in Europe, which means they can pass some of that saving onto the consumer. It might end up that Tesla are only making about 15% margin on some of the Model Ys they sell in some markets, and then perhaps they're as high as 30% in other markets, and then it averages out. And the 30% margin vehicles are the ones that Tesla are ramping up the most now. The 4680 is the sweet spot for Tesla, offering all-wheel drive with still a 280-mile range. Funny how it's pretty close to the rear-wheel drive Model 3 for range. They have so much data on those cars and how tolerable the range is to deal with, Tesla know all the costs and worked out how to reduce the cost a Model Y as best they can, having already built factories around it. And of course the Model Y being similar to the Model 3 with 70% of the same parts. Even more economies of scale. Economies of scale. This is hopefully what it comes down to. If I recall, when the Transistor started in production, they sold at a huge loss, but they had done the numbers. If production increased to the level of demand they could achieve at these lower prices, then eventually it was going to become profitable. If I recall, I think it was Robert Noyce's idea, who later went on to co-found Intel. So you scale up production, then the product simply becomes lower cost for each additional unit, thus making the average cost of all units lower. Essentially, cost of goods sold per vehicle becomes lower. This should be what is happening at Tesla. We saw how much Tesla ramped up production at Shanghai towards the end of last year, about a 30% increase in production from the same factory. That obviously reduces cost. We're seeing how much less labor is required per vehicle too, not just in Shanghai, but in Fremont as well. Of course, supply chains are improving, shipping costs have come down, lithium prices are down, and other various costs across the board. Tesla's costs are coming down, and their manufacturing is improving. The cost of their vehicles is thus reducing as a result. By how much, we don't know, and this Q1 earnings report will give us the best indicator, almost as if it is the most important earnings report yet, which tends to be how every earnings report feels. Whether you're happy about these lowered prices or not, I can tell you that the competition certainly isn't. As Tesla's prices are already significantly lower as of lately, any price drops from here really start competing heavily with ICE cars, especially cost of ownership. It's one thing being at price parity with BMW or Mercedes, but when the prices come down to Ford and GM equivalent ICE vehicles, it's got to be concerning, especially when legacy autos are about $30,000 behind on what their EVs are costing to build, and their production numbers are even further behind again. I know it can be somewhat concerning seeing prices come down and potentially $600 million less in gross profit for a quarter at these lower prices, but this was inevitable. If we want to see the mass adoption of EVs, then we have to be realistic as to how many people can actually afford them in the first place. No one has gotten costs down like Tesla for EVs like for like, so it had to be Tesla that set the price points for the mass market, and they will continue to do so with the new Gen 3 Tesla. And in order for Tesla to get these prices down, they need to continue growing and taking advantage of more economies of scale, vertical integration, and efficient manufacturing, like we're going to see with the Model 3 Highland update too. The Highland will likely cost less than the previous Model 3 to build. Tesla are not going to slow down and will keep building out these models in order to reduce the cost. There will eventually be an optimal cost that Tesla find where demand meets supply. Once that is found, then Tesla just need to keep on working on reducing the cost further and can then start building up margin again. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.